Let's jump right into it. Welcome to this explainer, where our goal today is incredibly simple. We are going to make the foundational building blocks of banking so crystal clear that by the time we wrap up, you'll have zero doubts left. We're giving you the exact structural knowledge you need to just absolutely crush your upcoming exams.
Here's the agenda for our deep dive today. We've got 6 parts. First, the evolution of banking. Second, central versus commercial banks. Third, structure and alliances. Fourth, ownership and special banks. Fifth, banking laws and the Basel Accord. And finally, number 6, customer relationships. Let's get to it.
Kicking things off with Section 1, Evolution and History of Banking, going from ancient times all the way to modern finance.
So if we look back at the historical milestones, it's pretty wild. Around 600 BC, we see the Shaanxi Bank in China pop up, which is widely considered by most to be the world's very first bank. Then you fast forward all the way to 1157 AD, and the Bank of Venice in Italy swoops in to take the title for the first organized commercial bank. But it actually wasn't until the 17th century that our modern concepts of things like paper money and central banking truly emerged. Now, a quick heads up for you. These are highly tested historical dates, so you absolutely need to lock these into your memory.
You know, it's actually fascinating to look at the specific contributions of our 3 main ancient financial ancestors. Think about the goldsmiths. They were these trusted wealth keepers, right? Well, the simple act of depositing valuables with them literally birthed the modern check. Then we have the moneylenders. They started lending out their idle funds, but demanded collateral in return, which directly paved the way for our modern mortgage policies. And finally, the merchants. They naturally wanted to avoid the high risk of carrying big bags of cash on their travels, so they created these written orders called hudi, and that laid the groundwork for what we now know as bills of exchange and bank drafts.
Moving right along to Section 2, central versus commercial banks, specifically looking at their core objectives. Now, the crucial dividing line here is their ultimate motive. At the end of the day, commercial banks, think of places like Sonali Bank, are fundamentally driven by profit. It's a business. They take our deposits at a lower interest rate, lend that same money out to entrepreneurs at a higher rate, and just pocket the difference. Central banks, on the other hand, like Bangladesh Bank, they honestly couldn't care less about profit. Their whole game is public welfare. They maintain economic stability and act as the absolute undisputed guardian of the money market.
All right, into Section 3, bank structure and alliances. We're going to cover unit, branch, group, and chain banking.
So, when we evaluate structural types, we can clearly see exactly why branch banking totally dominates in places like Bangladesh. Picture a unit bank. It operates out of one single office in a specific area. If a localized disaster hits that one spot, boom, that bank faces an intense liquidity crisis. It's incredibly vulnerable. But branch banking? That operates via one main head office but utilizes numerous branches both domestically and abroad. This allows for super wide risk distribution and a much higher capital pool.
You know, there's a really subtle but absolutely critical difference to catch when independent banks form alliances. Group banking is entirely about ownership and control. Basically, a massive holding company comes in, buys up the majority shares of smaller subsidiary banks, and essentially diminishes their independence. Chain banking, however, is a totally different beast. It's purely about mutual cooperation. These independent banks form an alliance simply to avoid fierce competition with one another, strictly maintaining their separate legal entities without anyone dominating anybody else.
That brings us to Section 4, ownership and specialized banks. Who really holds the power?
When those tricky exam questions ask you about a joint ownership bank, like Rupali Bank for instance, I want you to permanently anchor this breakdown in your mind. The government holds exactly 51% of the ownership. Why? To retain ultimate control, of course. Meanwhile, the private sector holds the remaining 49%. 51-49. Lock it in.
Now, identifying a bank's regulatory status really just comes down to scheduling. Scheduled banks are strictly listed under Bangladesh Bank's orders. They have to comply fully with its mandates. Think of the big ones like Sonali, Janatha, or Agrani. Non-scheduled banks, though, they're formed by special independent laws, meaning they aren't strictly on that primary central bank roster. Great examples here would be Grameen Bank or Karmasenstan Bank.
Okay, here's a quick cheat code for your exams. If a question prompt mentions the development of a very specific economic sector, like, say, agriculture, it is referring to a specialized bank, like Krishi Bank. It's targeting a specific thing. But if the prompt mentions a geographic boundary or a specific community, then you're looking at a regional or group-based bank. Think along the lines of the Asian Development Bank or the Islamic Development Bank.
All right, Section 5, banking laws and the Basel Accord. Let's look at the rulebook.
Here are the absolutely non-negotiable legal facts you just have to know. First up, the big one. All banking activities in Bangladesh are governed by the Bank Company Act of 1991. Second, our central guardian, Bangladesh Bank, actually began its operations on December 16, 1971. Before that, it was known as the State Bank of Pakistan. And finally, you've got the Basel Accord. These are incredibly vital international guidelines that were established all the way in Switzerland, and they're designed purely for managing banking risks and keeping global financial stability in check.
And hey, speaking of those global risk guidelines, under the Basel II Pillar 1 regulations, a scheduled commercial bank in Bangladesh is forced to maintain a very specific minimum paid-up capital. And that magic number? Exactly 400 crore taka. Seriously, write that down, highlight it, do whatever you need to do to commit that exact number to memory.
Wrapping up the structural stuff, let's head into our final section, number 6, banker-customer relationship and garnishee. Basically, the legal ties.
Now, the garnishee order can often sound like this scary, super confusing legal jargon, but let's make it crystal clear right now. It is simply a court-mandated freeze on an account. That's it. Let's say you owe money and just flat out refuse to pay. Your creditor can take you to court. The court will then issue this garnishee order directly to your bank, literally legally forcing them to freeze your funds so that your debt can be settled.
So, in any garnishee order situation, you're always dealing with three parties. You've got the court, or creditor, also known as the judgment creditor. You have the debtor, whose account is frozen. And then you have the bank itself, which acts as the actual garnishee. And while we're on the topic of legal ties, just remember that a banker-customer relationship doesn't just last forever. It legally and formally terminates if the customer passes away, faces mental instability, goes bankrupt, or gets hit with direct court orders. Or honestly, it can just end from a simple mutual loss of trust that leads to a formal notice of closure.
We've just spent this time digging into structures that are built all around physical branches, geographic regions, and really strict national laws. But as you continue to study and prep, I want you to consider this. How do you think tomorrow's tech, stuff like fully digital, completely borderless banking, is going to disrupt these exact historical structures and rules we just learned? It's kind of a wild thought, right? Keep that in the back of your mind as you study. You're going to do great on your exams. Thanks for joining me on this explainer, and keep learning.